to Investors Guide. You're watching ET Now. I'm so glad you tuned in. This is episode number 199, which means next week the show is going to turn 200. It's very special for us, and we'd like to invite you to join us in the studio. Send in an email and give us your details, and we're glad to have you as part of our audience in the studio for our very, very special episodes next week. But that doesn't mean we're not working this week. On the show this week, we'll find out how you can make your salary stretch to last you 30 years as we help a conservative woman investor plan her future. In our product review this week, we look at the IDFC Premier Equity Plan, and we'll find out if you have a home loan overseas, should you be investing money in India to beat that interest rate. Alright, it's time for me to bring in Kumar, the CEO of Value Research and our in-house mutual fund expert who joins us on this show every week. You've spent the last 4 years helping us with our mutual funds. Thank you and welcome to Investors Guide. Our first question comes in from a woman investor. Dr. Jyoti is a 38-year-old teacher in a postgraduate dental college. She has a monthly income of 1 lakh rupees. Now, she seems to have enough health insurance by what she tells us, and she doesn't have any dependents, so I don't think she needs life insurance right now. Now, if we look at her portfolio, she's a very conservative investor. 1 lakh rupees going into her PPF account, 8 lakh rupees in fixed deposit, and another 10,000 rupees going into a recurring deposit every month. Now, she says her salary is going to be her only income, and she foresees that she'll work for another 10 years at least. She wants to sort out her expenses for the next 30 to 35 years. So when you take a look at her portfolio, for this very obviously conservative investor, how can she beat inflation over the next 30 years?
My sense is that, her conservatism will actually prove very costly because despite such savings rate and, working hard through a lifetime being conservative, she will end up being poorer because inflation will eat into her capital. Not only that, the money, the way it is saved today, it is not able to match inflation. So effectively her savings in real terms, in real value terms, is going down in value. So I would say that, despite her conservatism, still 10 years ahead, still to go, at least to work maybe more. I think it's very crucial for her to be in some real asset. I think equity is inevitable. So, and with time on her side, she must understand that equity is very risky if you take a big bet at one go, if you don't diversify, if you don't stagger your investment. But if you do all of this, then I don't think, equity is as risky as it's being made out to be. It's very important that you get started. Get started conservatively. Don't get started with 100% all equity savings plan. So I would say that, at least a small part, make a modest beginning. Invest 5,000, 10,000, 15,000, whatever you can. Beyond your PPF, beyond your fixed deposit. Don't touch all that because, it will be very difficult for you to lay your hands on that and move that money into equity in any form, going by your profile. But I would say that start accumulating small savings conservatively in our stable growth portfolio. Choose 1 or 2 balanced funds, invest regularly, and I think it is not a matter of choice. It is not a matter of my persuasion. It is inevitable. Otherwise, it will prove to be very expensive for you.
Dr. Jyoti, on your screen right now is our stable growth portfolio for balanced funds. It's a very conservative way to approach equity. If you have any more questions, you can write to us on the email ID at the bottom of your screen. Then we have time for one more question. Mukesh has written in, and he has 50,000 rupees that he would like to invest to make up for a shortfall in his 1 lakh rupee ATC deduction. And he wants an investment with a short lock-in period, and he wants to know which mutual fund he should invest in. Well, Mukesh, the 3-year lock-in period on an ELSS is the shortest you will get in the market. Virendra, would you help me choose a couple of tax-saving mutual funds?
Yeah, sure. In fact, the tax-saving funds are the only tax-saving avenue with the shortest lock-in period. All other tax-saving options, they come with a longer lock-in. So this is the shortest you can have, which is 3-year lock-in period. And 2 conservative picks from the tax-saving fund, I would say Quantum Tax Saving Fund, and Franklin Tax Shield. These are 2 relatively conservative, more stable. If I look at, high performance in recent times and showing the momentum, riskier and that might be worth it because you get logged in for 3 years anyway. That will be Axis, the tax saving fund from Axis, and Religare Invesco tax plan.
Alright, those two tax plans are on your screen right now, along with two more that Virendra recommended earlier. And since we're talking about tax saving funds, Somu has written in that he invested in the Birla Sun Life Tax Relief Fund and the DSP BlackRock Tax Saver Fund in 2009. He tells us portions of his investments are now out of the lock-in, which means he can partially withdraw his money. He wants to know if he should hold on to these two funds or maybe switch to a different fund that will give him better returns. What would you recommend on these two funds, Birla Sun Life Tax Relief and the DSP BlackRock Tax Saver?
I would say based on performance, Birla Sun Life Tax Relief 96 is a fund worth getting out because this fund has been a very disappointing fund over the past 5 years. It has continually underperformed category and on occasion not been able to beat the benchmark. So I would say that is a clear case of exiting the fund based on performance. DSP BlackRock is a reasonably performing fund, and equity fund performance is cyclical as much with the market, so that might be worth holding on. There's another reason why people should, sometimes recycle their money. If you are facing liquidity issue or you have a liquidity constraint and you don't have money to, tax save is money earned. So if you are unable to avail the entire entitlement of under Section 80C, it might be worthwhile to take your money out, consume this, and save your other part of your income from your income. Invest. So recycling your money in the tax saving fund to avail the tax benefit if it is out of lock-in is just as important, even if it amounts to taking your money out and investing again.
Alright, Somu, if you want tax saving funds on your screen right now are the funds that Virendra recommended a little earlier on the show. Coming up after the break, Virendra is going to stay with us and we'll review the IDFC Premier Equity Plan, find out if you should stay invested in this fund. Don't go anywhere. Welcome back. You're watching Investors Guide on ET Now. Thank you for staying with us. Virendra Kumar is with us as well, helping us with our mutual fund investment. It's time for our product review, and this week we're looking at the IDFC Premier Equity Plan. Avan is here to give us a very quick introduction. Avan.
Thanks for that, Faith. Well, our fund under the scanner this week is the IDFC Premier Equity Fund. This fund has given returns of 20% since its launch in September 2005. It has consistently beaten its category average in bull runs and has managed to contain the fall during the bear runs. The fund manager is quick to switch the asset allocation during various market cycles. During the downturn in 2008 and 2011, it allocated the assets and increased the exposure to debt and cash. This strategy helped the fund cushion its fall. The fund manager picked stocks with the potential for long-term growth and good valuation. The fund heavily focuses on sectors like FMCG and financials. Let's get some numbers to give you a better perspective. If you invested in this fund when it launched, you would have 3,875 rupees today. So should this fund be a part of your portfolio? Our experts are here to give you the answer. With that, it's back to you, Phil.
Thanks, Avan. Virendra, IDFC Premier Equity is part of the portfolios you've designed on this show. It continues to beat its benchmark and its category average. How would you place it? Is this a must-have fund in all of our portfolios?
Yeah, it is a must-have aggressive fund. And aggressive because, it's a very unusual fund. It's very difficult to slot it. It tries to be, and in the last 7 years, it has been able to give twice as much as other funds in the category. Based on its portfolio characters, at value research, it gets slotted as a mid and small cap fund. But it is not a mid and small cap fund by design. It has beaten its benchmark in almost every year. Particularly, it has been impressive in years when market has crumbled by being in very unusual stocks which is otherwise not visible in other funds portfolio. So it's a very different fund, very unusual picks, and it has mostly been right. So and it's very difficult to summarize its strategy. It's just that fund manager has been extremely selective with his unusual picks, which has worked very nicely and consistently. And that has translated into a very wide margin through all these turbulent, years, the last 5-6 years when equity has not delivered any meaningful return. And looking at its little over 7-year history, this has given substantially higher return than most other funds as well as a benchmark.
All right. So this is a must-have fund in all of our portfolios. Reza, you did give it 5 stars when we reviewed the fund last year. Are you going to hold by those 5 stars and remain at the same rating again?
Yes, absolutely. This remains a 5-star fund. It remains, if one has to choose a fund which is aggressive and for the long run, because in short period of time it might be very disappointing, but one should not be in an equity fund anyways for the short run.
5 stars there for the IDFC Premier Equity Plan on Investor's Guide. It's time for our hold or sell segment. Well, Jagdish has written in from Bangalore. He tells us the returns of his mutual fund portfolio have disappointed him, and he wants to know if he should now redeem the money and switch to better funds. Now, if we look at his portfolio, it's obvious that he picked a lot of these funds when they were buzzwords in the market. First 2 funds in his portfolio are the ICICI Prudential Infrastructure Fund and the Tata Infrastructure Fund. Should he continue investing in these funds at all?
No, not at all. In fact, for a while now, in fact, for quite some time now, we have been suggesting investors that they should not be into a thematic fund in the first place. And infrastructure has bigger problem. One is that these companies are unlikely to regain their glory quickly. Even the environment is very hostile. They will do well at some point, but anytime in recent future, unlikely. So one should have exited these funds even earlier, but nevertheless, one should exit them right away.
Well, it might hold true for the rest of the funds in his portfolio as well. He has the Reliance Diversified Power Sector, the DSP Merrill Lynch Natural Resources, and the Reliance Natural Resources Fund, and that forms his entire portfolio. Does it make sense at all, Virendra? Would you want him to hold on to these funds?
No, not at all. In fact, all these funds are likely to be extremely cyclical. They will do very well in a narrow time frame. But it will be very difficult for him to capture those gains. And I think there is a lesson here from what I can make out from these selections is that investors normally get carried by either a hype around a theme, which would have been the case in case of him taking the infrastructure fund, or there are points there are times when recent performance drives our selection, and there was a time when all these funds were the best performing fund in a time when the whole market otherwise was struggling, the Reliance Diversified Power Sector or the Natural Resources Fund. So give up. This is not the way to approach your portfolio. And don't give up permanently. Approach it methodically. Pull your money out. Move your money into diversified equity funds. And from here on, start your SIP. I also feel that, he is more disappointed because all his investments were made in lump sum.
If he pulls all of his money out of his portfolio, where would you like him to invest that money now?
I would say he should choose one of the two, aggressive growth or growth, and time is on his side. Going by this, his current selection looks like he's seeking aggressive growth, which has not materialized. So he should. And when he moves into our aggressive portfolio, he should stick to that plan for 1 or 2 years, invest regularly, and not look at return even when the market gets very turbulent, because that's the time when he's actually accumulating cheap. So that belief is extremely important when he's getting started.
All right, on your screen right now is a portfolio that Virendra recommends for you. Remember, the important thing to learn from all of this is to stay away from very thematic funds and pick funds that invest across the broader market. It brings down your risk, especially if that particular sector you've picked goes through a tough time. Virendra, we have a question from Sandeep, who has a time horizon of 20 years, he tells us. He's very young. He tells us he wants to invest in gold ETF, and he wants you to help him pick two of the best gold ETFs in the market. Of course, gold ETFs are not very different from each other, but would you recommend that he puts all of his money in a gold ETF, and how should he pick that fund?
So one is that if I can persuade him, gold ETF should be a very insignificant part of his investment. And I'm not very optimistic about the kind of performance we have seen from gold in future. So one should be extremely cautious, and one should be looking at gold ETF as a very opportunistic investment. You work with a target, you try to achieve a return, you have a thinking, or you have the stomach to walk out with a loss. So that is something which one should take into account. Don't get carried by what we have seen over the past 5 years, and recent weakness in gold prices is tempting you to have exposure. So have that sense of balance, and long-term investment, it should dominantly be equity or fixed income, and periodically rebalanced depending on your appetite for risk, how much turbulence you can accept. Choosing a great gold ETF, I don't think, my advice is very useful. Yes, to some extent, the larger the fund, the superior it might have some advantage of scale. That might translate into an advantage of about 5 basis points on an annual basis. And clearly, the first mover advantage goes to Goldman Sachs Gold Bees.
All right, so the Goldman Sachs Gold Bees is the best option for you because there's a small, minute difference in the advantage this gives you because of its size. Other than that, most gold ETF funds are identical. And of course, Virendra, they're telling you to limit your exposure to gold. It can't be your entire portfolio. Especially if you look at the returns over the last year, you'll see gold has actually given a negative return over the last 1 year. We have time for one more question. Arish Joshi has written from Delhi, Virendra. He's been investing 2,000 rupees a month in HDFC Top 200 and in the Franklin India Prima Plus Fund. He has a time horizon of about 5 years, and he wants to know if he should continue investing in these funds or should he be redeeming his money and moving it into other investments. He does tell us he is looking for strong returns, but with only 5 years on his hands, where would you like him to keep that money?
If all this money is free from any lock-in, is free from any short-term capital gains, and of course, if he's doing his SIP, the investments made in the last 1 year may not be, and the market has gone up. So the money which is exempt in money invested in these funds, which is exempt from capital gains, which is investments which are over 1 year older, he should move to our stable growth portfolio, move into balanced fund, because 5 years is not long enough for him to the possibility of steep market decline. The other strategy which he can follow is continue his funds are good, but they are all equity funds. He can continue for another 2 years, and then the way he is doing his SIP, he should start withdrawing it methodically as well.
It depends on how committed you are to that goal in 5 years. If you think it's a hard goal and you will need that money in 5 years, then Virendra said, stay with the funds that you have right now, and as you move closer and closer towards that goal, start moving your money into more conservative investments. Virendra, thank you so much for joining us on Investor's Guide and answering all of our questions. Of course, you can join us in the studio yourself for our next week's special. Write to us if you'd like to be part of our show. Coming up after the break, we'll find out if you have a home loan overseas. Should you be prepaying it or investing your money in India for better returns? Don't go anywhere. Welcome back. You're watching Investor's Guide in ET Now. Thank you for staying with us. Let me bring in Gaurav Mashruwala, who will answer some of the questions you sent in during the week. Gaurav, thank you so much for joining us on this show.
Thank you.
Let's get straight to our first question. Amit has written in. He writes in from Ireland. Now, he tells us he took a home loan of 370,000 euros with an interest of 5% for 33 years. Now he wants to know, because he has some spare cash, if he should be paying that loan off, or should he invest the money in mutual funds in India and sort of beat that 5% interest rate, which would be a better option? Gaurav.
Amit, my suggestion would be that start paying off loan. Because if you are looking at a situation whereby you are saying that because you have borrowed at 5% in Ireland and you want to deploy that money in India where India would generate a higher return, you are taking two risks. One is the risk of Indian equity markets going up and down. Second, again in India where there could be tax implications coming at a later date. But third, most important, the currency risk. Now, your returns would get impacted either positively or adversely based on the currency movement. So, if you're going to say that you're borrowing at 5%, you want to send money into this country and then do it, I would not encourage do it. More so if it's a house where your family is living. If you're saying that you want to invest purely because there are better returns, then I would encourage you to take an offshore route instead of bringing funds directly into India. There are several offshore mutual funds which focus onto Indian markets, but you don't have Indian tax implications, you don't have to adhere to Indian regulations, KYC. So that will ease. These are legitimate ways of bringing money into India. These are funds which are recognized by SEBI, etc. So there are no manipulations happening. But instead of bringing money into this country and dealing with all the administrative aspects, and if tax implications come at later date, you are better off doing an offshore route. But my recommendation would be pay off loan. That's better for you.
Our next question comes in from Naveen, who says he wants to invest 20,000 rupees a month in mutual funds for the next 20 years. His aim is to create long-term wealth for his family's needs. He tells us he has 2 little children and his parents to support. He has 1 lakh rupees going into his public provident fund every year, and he doesn't have any life insurance. What should he do? Well, Naveen, on this show, before you go anywhere further, we'll tell you need to have an emergency fund, you need to have health insurance, and you need to have life insurance. There's Gaurav to help you with the rest.
Naveen, couple of things. Thanks for giving detailed information about your family, dependent parents, married, kids, etc. So here are steps that you should take. If you are the sole earning member of the family, then ensure that you have life insurance as well. You can't depend only on health cover because, yes, while there are illnesses, and if there are any illnesses, your family is covered through health insurance and your employer could also be giving cover. But in case of untimely death, then family will be in difficulty, and hence ensure you have life insurance. That's number one. Apart from that, for your investments, there could be 2 kind of responsibilities coming up. One could be elderly parents, and hence ensure that if they are dependent on you, then you keep aside certain portion of money for health-related emergencies. So while there could be health insurance, so that will cover only treatment in hospital, create a small corpus which can be utilized to fund parents' treatment at home. Once that's taken care of, then the rest of the money can be put in equity mutual fund and gold fund, because marriage will also require an amount of gold. So, but you have a long horizon. So both these asset classes are good. As far as gold is concerned, if you're an savvy, go and do an online trade for gold ETF or through a broker. As far as mutual fund is concerned, start with an index fund if you're not familiar, and then move on to a large cap equity fund actively managed.
Alright, last question on the show. Dipankar Shah has written in. He's 25 years old and he has a monthly income of 40,000 rupees. Gaurav, he tells us he wants to buy a house in the next 10 years. It's going to cost him about 50 to 60 lakh rupees, and he wants to put together the corpus for the down payment. But from my calculation, he's going to need about 12 lakh rupees. But the thing he should consider, Dipankar, is that the home you like today is possibly going to be much more expensive at the end of 10 years. So not only should you be putting that money away, you should also be beating inflation. Gaurav, what would you recommend he does?
Dipankar, that's great that you are thinking about your house 10 years ahead. Very few people do that and plan in such a nice manner. What I would encourage is to start an SIP into an equity-based mutual fund. If you're comfortable, then go for a large cap equity fund. If you're not, then pick up an index fund. Keep doing an SIP, which will, over a period of time, in 9 to 10 years, can generate about 12 to 15% annualized, even more. This is the past record of general investments in equity fund. Even if economy goes through downturn, these are kind of returns in an SIP one is able to generate. So do an SIP into an equity-based mutual fund. About 2 years prior to your funds requirements, start moving the corpus from equity to debt. So at the time of buying of house, even if equity market is down, your profit which you would have accumulated does not go into downturn. And then use the amount for down payment, and for residual amount, take a loan.
Remember, if you have questions for any of our experts about anything to do with your money, write to us. The email ID is at the bottom of your screen. Thank you for watching Investor's Guide. Remember, next week is our very special 200th episode. You can join us in the studio if you like. Tune in next week to catch Investor's Guide. Thanks for watching.